Good day, traders. Welcome to the Flow Show. It's the day after the night before, and fun and games at the Bank of Japan. Morning, lads.
Morning, guys.
How are you all doing?
Yeah, not too bad.
Yeah, good, man.
Good. Right. Well, obviously, we probably better leaving the Bank of Japan stuff to last on the subject list. So we'll crack on with some of the other bits and bobs first. Starting in China, VP Liu was up at the WF waxing lyrical about China, saying it's past its COVID infection peak. Things like dining, consumption, and tourism are returning to normal levels. So all going swimmingly over in China, that they'll lead us to believe. There's been a few more noises, let's say diplomatic noises, about easing the tensions and getting on with the US and others from these guys at the WEF. So that sentiment is continuing. Let's hope it means something in reality, rather lip service. Because if it does, then if we do get further easing of tensions between China and other countries like Australia, like we've seen with coal, it is going to be an improvement or a boom for risk and risk assets, particularly commodities. Coming over to the UK, and a bit of data out this morning. CPI coming in pretty much round about as expected. The core number was expected to dip a bit further, but it didn't. It came in unchanged. The headline number came in as expected, confirming a 2-pip drop. Not dropping back as much as we're seeing elsewhere, which potentially is going to be a bit of a problem for the Bank of England. I'm still of the mind inflation is unlikely to come steamrolling lower like it might elsewhere. There's still plenty of inflationary pressures in the pipe, including, as mentioned several times, these wages and strikes deals that are yet to be resolved, and that will bring an added pressure to the inflation pot. We've also got the energy situation where energy prices are likely to remain high in the UK, perhaps than other countries, and the government support to curb the energy price rises will be ending. And if we aren't getting any wholesale price moves lower for households, then prices are going to remain high, and if not, climb higher. So I'm not sharing the view with the Bank of England and the UK that inflation is going to pull back as fast as it may do in other countries, and that may force the Bank of England to continue hiking longer than some of the others, but still to be monitored. And speaking of monitoring, there was a survey done of ECB staff yesterday or sometime over the last week or so, and apparently they are losing faith in the leadership of the ECB as inflation continues to bite. Now, this is the same ECB staff who produce the forecasts that the leadership look at to decide monetary policy. So if they're losing faith in the leadership, they're the ones who are literally behind the leadership, informing them what to do. So, you know, typical EU, always looking for someone else to blame. Who was that piping up? Was that you, Stel?
Yeah, it's exactly what you said. So anyway, you know, like you said, you always need to find somebody to blame. But yeah,
it's crazy.
Yeah, you know, you're talking about UK inflation, and it is dropping at a slower pace than, say, the US or Canada that we saw yesterday. Was it yesterday? Yeah.
Yeah.
You know, the UK, the EU, there's a lot bigger dependence on, you know, oil, gas. You know, the energy aspect of inflation is higher, and as a result, you get we are seeing, like you correctly said, earnings rise. Average earnings rose higher than expected last. Was it yesterday on the UK?
Yeah.
So, you know, as long as you see earnings rising at a pretty decent pace, then you're going to get second round effects, and inflation is going to get stickier. That's why I think Europe and the UK is going to be a little more tricky to bring inflation down than, let's say, the US.
Yeah, absolutely, mate. I agree wholeheartedly. I still think the BOE potentially going to hit 5% rates, which is going to be a lot lower than the market expects. But while we stay on the ECB, there was a Bloomberg sources piece out yesterday saying that the ECB may opt to switch to 25 pip hike in March following a 50 in February. Now, if Madame Lagarde was to be believed at the last ECB, it was going to be 350s on the trot. Then Bloomberg dropped that little sources bombshell yesterday, which hit the euro because obviously less hawkish than the market was expecting. And it took quite a while for the denial to come, and it came actually this morning from Villeroy in a Bloomberg interview on Bloomberg TV, saying he was quite surprised by the story published by Bloomberg that the pace of tightening may slow down. So knocking that on the head. So another bit of fun and games with the headlines on that. Also yesterday, Villeroy said that rate hikes are made easier by a resilient economy. Now, just to switch to yesterday and some of the data still mentioned, Canadian CPI, one of them. As you can see there, CPI came in, dropped back further than expected, 6.3% versus 6.8% prior. So, we are seeing decent chunks coming off there. There are various measures counting the core numbers in Canada, but by and large, they all were coming lower. Core CPI 5.4, well below 6.1. It was expected to rise to 6.1. On one of the other core measures, coming down to 6.6% versus 6.8% prior. As you can see there, also some of the other 30 attempts at gauging inflation all coming down a bit as well. So that keeps things ticking along nicely as far as the Bank of Canada are concerned, expected to continue their slower pace of hikes and maybe even come into a pause at some point. Over to the US, and got a bit of a surprise from the Empire Manufacturing, the first manufacturing data of the month, dropping to minus 32.9. It was expected to improve to a less rubbish minus 8.7, but it completely fell out of bed. Some of the other numbers, the underlying components as well, not looking too healthy. Employment came in at 2.8 versus 14 prior. Prices paid, that inflationary number we always look at, 33 versus 50.5 prior. New orders minus 31.1 versus minus 3.6 prior.
I think Ryan, I think we can kind of attribute some of this very negative stuff to the particularly bad weather that US and New York had. So maybe part of explanation is that, but it was a pretty damn negative number. Yeah,
exactly. And the only positive was 6-month expectations, which rose to 8 versus 6.3 prior. So yeah, it's potentially a bit of a weather-related issue there that could be explained. It is a wild number, so possible to see some snapback. And on that front, I was going to remind as well, keep in mind that this weather impact may be seen in the next NFP report, which will be for January. And the reporting period is right in the middle of all these bad storms and bad weather. So that may be an impact we see coming out there as well. And while we stay in the US, Fed's Barkin said we cannot declare victory over inflation too soon and doesn't favour backing off too soon. Says he wants to see inflation compellingly headed back to target. Aside from all the Davos speakers, we do have a few Fed heads out today, which you can see on the calendar if you're in the ForexAnalytix platform. We do have Bullard speaking with our mate Timmy Leaks today as well in a special interview, so keep an eye out for that one as well. Right, over to the main event, and what fun and games. I did set my alarm for 3 o'clock, but I'd already missed it by the time that went off. So I woke up, had a look, went back to bed again. Kay, you're up for it. Bit of fun and games. Before I get you up,
so.
let's just run over the the main highlights. We did also get some data out of Japan as well. Let's see where that is. Is that down here or behind? So the Tankan, which is a pretty big index over there, falling to -6 versus 8 prior. This is again in the manufacturing area, which hasn't been looking too hot compared to some of the other areas. You can see some machinery numbers there, or orders going into negative or producing negative prints for November. So once again, a bit of divergence between what we're seeing in the sort of services and the manufacturing side of things. Let's have a look. I think that was it from Japan. Yet for the data wise, industrial production, which was a little bit again it was up as expected, 0.2%. Capacity utilization down, so a bit ho-hum in that front. So the Bank of Japan, so they left everything unchanged. No changes to monetary policy. Going to keep easing as normal. So option A in terms of what we were expecting. Now, I'll go through the headlines, but what they also did, or what they threw up, was a bit of an enhancement to something they've been doing, and we've been speaking about prior. They've got this funds supply operation, which is offering loans at variable or fixed rates for set periods. Now, I think it was last week we had headlines coming out that they were set to do this for loans up to 2 years. Now they're doing it up to 5 years and can offer up to 10 years of this operation. I'm not really understanding the full ins and outs of it, but it is in an effort for giving loans so that bonds can be bought and keep yields in play. It's probably about a couple of steps down from doing something big like yield curve control. It's just another attempt to keep things, keep yields under control without tinkering with YCC. Kay, on that, what do you make of this loans thing? Is it a last resort thing?
Well, first of all, I set my alarm for 2:40 in the morning, and by the time I was on the desk at 2:45, everything was done and dusted.
Yeah.
So I missed as much as you, even being up earlier. So yeah, and to be fair, I didn't even see that loan thing. It's in addition to the YCC, right? It's not like to replace any of the YCC.
No,
it's another effort to keep yields down short in the shorter end and the belly of the curve. So yeah, it's a complete standstill by the Bank of Japan, and in that respect, I'm a little concerned by how the yen reacts here, because I had a couple of very quick trades, but in the side of a weaker yen also, and I also saw those machinery orders, the Tankan coming out. Nothing was really good for the yen yesterday. Yet after the initial spike, we spiked around what 4:30 our time. It completely reversed. I know the dollar is a bit weaker elsewhere, but I'm also looking at the yen crosses, and they are not holding too much.
Yeah, exactly.
I'm quite surprised, to be fair. I can understand positioning and things like that, but what Japan is doing and looking at the 10-year yield and shorter end, they are cooling down a little bit from the 50 mark on the 10s, to name an example. But the market is after the initial spike, it's completely shrugging it off. We're like, yeah, I mean, not even a big figure above where we entered the Bank of Japan.
Yeah. Eric's asked, why did you both miss the yen move? Was there a leak? No, it just came out earlier than usual. The window can be any time from usually it's somewhere between 3 and 4 a.m. UK time, but they dropped it early this time, and yeah, I set my alarm for 3 and it was all done and moved, and so yeah, I rolled over, went back to sleep. Some you win, some you lose. But just before we look in depth at the prices, just going to go over some of the lines that Kuroda put forward at his press conference. He said the economy is picking up, but the usual line: won't hesitate to ease monetary policy further if necessary. Core CPI is around 3% now, but expects it to fall below 2% next fiscal year, and cannot say we have reached a stage where prices are expected to grow sustainably and stably, and that's their big line. They want to see sustainably and stably, or stable prices. More time is needed to assess the impact of adjustments, and YCC is fully sustainable. Well, market seems to be trying to push those buttons on that sustainability anyway. He expects market functionality to improve by conducting nimble market operations. Will not rule out negative interest rates under this fund supplying operation. A labour crunch is expected to push wages up from now on. Today's decision, like the one in December, is not a change in Bank of Japan's monetary policy. And financial markets' expectations for a change in monetary policy have been corrected. I'm not sure about that, given where, as we've just been talking about, where dollar yen is now versus the reaction straight after the meeting. But he says the view of the Bank of Japan and market doesn't have to be the same. The enhancement of the fund supplying ops against pooled collateral doesn't entail a limit to yield curve control. So he's saying that this program doesn't mean there's going to be limits on yield curve control at all. Now, after that, we did get a couple of lines from the Trade and Industry Minister, Nishimura, saying that monetary policy is going to be normalised in the future, but until we see a clear path in future, the bank is going to maintain its policy. He then also said we are nearing a phase where monetary easing can be stopped, and the market, I think, jumped on that a little bit as well. Now, this guy probably has even less to do with Bank of Japan policy than maybe even Kishida, but the market is still looking for any crumbs it can get that the bank are changing policy. He also said that they need to increase wages at 5% and over. Now, looking at what's going on in dollar yen at the moment, we are coming all the way back, as I called it earlier, to the scene of the crime. I was quite surprised that we didn't see a pop higher than we did. I thought we may get something up towards 132s on a completely unchanged, but the market said it stalled out into the 131s. I am also surprised it's come back so quickly. I thought we might get a few sessions where, we float around the 130s, 131s, as a lot of the short-termers get kicked out and reassess that the bank aren't making any changes soon. So it has been a bit of a surprise. What I will say is, though, it feels like some of this last leg, probably from 129s, 50s, 80s down, is a bit more dollar driven, because we are seeing highs in a lot of the other dollar pairs for the day: euro dollar, cable, Aussie dollar, moving higher. So maybe there's a bit of dollar buying taken over this, but for dollar yen, it all amounts to the same thing. We've had the Bank of Japan spike. The market isn't letting go of the pivoting going on potentially to happen there, and we're coming all the way back down. What I did do is I added back into my dollar yen shorts the stuff I cut when we were moving down here initially from the 131s. I did back in. I did take a bit off into the low 130s. Never look a gift horse in the mouth. But other than that, I've just added pretty much back into what I had before, and happy to hold that position and add in any rallies still if we get any decent numbers. So my view hasn't changed. I still think the Bank of Japan are heading towards a policy change. Kuroda's only got one more meeting, hasn't he? The March meeting, and that's him done, isn't it?
Yeah. Yeah, that's
So,
the last meeting, and then in between, well, on Friday we get the CPI, which could make him already seen as a liar if it shoots up again. But if it would come back down, though, I think then we may see a second wind behind perhaps a bit lower yen. But yeah, this Nishimura guy is a bit of a strange one, because he's never been really any close to the Bank of Japan. Okay, he's been chosen by Kishida to be an economy minister as well, trade and economy. But he's clearly the one who killed the 130 when he started to talk. Yeah, I mean, still, I am quite surprised that we are down here. And as I said, yes, the dollar leg, but then with what the Bank of Japan did, and are going to keep rates lower where the rest are still hiking. Yeah, I'm a bit surprised that it's so vulnerable. So that makes me think that a lot of people, just like me then, this morning were trying to catch a knife and are forced out. Well, lucky for me, it didn't cost me much, because I didn't like the dead cat bounces, but and I made a bit of money overnight. But yeah, it's still a bit surprising that we are down here, and I would say not especially on the dollar yen, but then if you look at the yen crosses, they can't hold. So I'll look at a few of them.
yeah, Euro yen was very surprising.
Euro yen, sterling yen.
Yeah, all of them really showing the same.
Yeah, I mean, even the commodity yen, like Aussie yen, for instance. Well, I mean, of course, the dollar yen is a driver, and driving those crosses lower. But with the dollar being on the defensive, but still, I would have expected stuff like sterling yen and euro yen to hold better than it did.
Yeah, exactly. Stell, what was your thoughts on the BOJ overnight?
I always find it difficult to understand the BOJ. You guys are so much better than me. I agree with Tay. I think in the end we are heading towards a policy change, but you know, it's going well. Given that inflation in Japan is now what, 4%. You know, I would have expected them to be acting a little bit more than they have been. I think it's coming, but at a much slower pace. But what I'm personally doing, by the way, did you see the lows that we got today in dollar yen was exactly, I think, to the pip, the 50% retracement from the 20 January lows, or was it 31st of December lows? You know, the year-end lows to the this is 2021 to 2022, obviously, to the October highs. It was to the pip. Anyway, I think dollar yen is going to be going lower, but I think we're gonna. I'll be looking for a rally towards. I mean, we're in a channel, descending channel now. Yeah, you have the trend line there. I'll be personally looking for a rally towards the mid 132s. To try and short this, but I think the medium-term path for this, I think, is lower. I think most yen pairs are going to be going lower, but so yen strengthening. But this move today, and the reversal of most of it, kind of makes me think that we are going to see a little bit more upside first before we move lower. Just my 2 cents.
Yeah, no, that's cool, mate. I get that completely.
I'm looking to sell yen pairs, basically. That's my bias.
Jump on board, mate. It's a good train at the moment. There's that CPI data that's coming out tomorrow night. Core inflation is expected to tick up to 4% from 3.7%. So that's to keep an eye on there. If it comes up hotter than that, we should see dollar yen falling further as the pivoters put their claws in even tighter. I'm not sure how strong a reaction we'll get if it's in between there, in between expected and the prior. Certainly, if it's weaker than 3.7%, then we could be seeing a similar action in dollar yen that we've seen today with the BOJ, and it might be that it shakes out a few more of the short termers. My view of this morning is twofold. Half the reason why I think we have come back so quickly is obviously a lot of people were getting out of positions into this, you know, taking some risk off the table, and now they've seen what the Bank of Japan have offered. It's not a lot, and now they're doing a bit of re-establishing their positions as well. So I think there's lots in the mix. So what do we do from here? We've got this, you know, bit of a traffic area in the 128s, 129s. What will be important is whether we get down to any of these lows, down to that 128, down into the 127s. If we get down there, I want to be watching very carefully what happens. If we start to find, you know, decent support here, anywhere between that 128 and these low 127s, that's going to suggest the market, for all its expectations for a change at the Bank of Japan and maybe for what's going on at the Fed, this is the area where they're comfortable pushing the boat to and not any further. If we get that, then it sets up for maybe some sort of decent bottom, and then we get a rally up. But conversely, we could get this sort of action that we saw over here, where we had a low, then we had a stepping up, got a decent bounce, and then wallop, sometime later it all gets washed out again. So all we can do is watch the techs. I had a level at 131.25. This line I've put in today. Kay, I think you had 131.50 as one of yours on the hit list.
Yeah, 40.50 was the first level, and then bigger in the 132.85 figure zone.
Yeah, up towards those areas there. So it has defined the level. So the top side marker for now is around this 131.50. And now we just need to see what we do in the middle here. Are we going to start finding resistance coming in against this potential old level, maybe this old level? So it's going to be a bit of price discovery from here. So once again, we look at the wider edges, which is now 127, low 127s, 131.5, and see what happens in the middle here. Now, I did mention that it is looking a bit dollar bearish at this stage of the move, and we've seen that in euro dollar, as I say, Aussie dollar, which I'll take a quick look at. This 108.70 level, it's a bit of a brick wall, isn't it, boys?
It is, and it's funny that it's right there, because the real level to me is like 20-30 points higher, but yeah, 30-40 points maybe higher. But we've seen similar thing in the euro sterling as well, where they're stopping just right before an important level. So yeah, there's people around there who probably are happy to take profit. They must be take profits layered up to 109, and if 109, 109.10 or 15 or so gives way, then we could see an acceleration. But yeah, there seems to be sellers lined up there who don't believe that euro or who are happy to take profits. But equally, I find the 107, 60, 80 zone starting to look quite big.
Yeah, that as well. I think we're probably likely to be seeing some decent stops building above this level now. We've had several attempts at trying to crack it. You know, it has held, you know, very, very strongly. I like it when it's nice and clean, almost to the pip. It's holding a level, but that does mean that whoever's shorting it up here is potentially building a bigger and bigger position. And if they are going to have some stops, we could either see some just on a break, maybe through 80s. Maybe they're sitting up just above 109s and using that as a final line. So potentially, if we get a break here, it could be a bit of a kicker all the way up through there. Sorry, mate.
Plus, you're going to get, no, I was going to say, plus, if we do break, because like you said, it's so well defined, if and when it does break, then you're going to get technical people coming in saying, well, okay, resistance break, I'm going to get long here. So you're going to get a move, initial move that's, you know, spikes quite nicely. Then obviously after that, nobody knows what happens, but initially that should happen.
Yeah, and if that does happen, I'll be looking for this level to be a decent support level thereafter. Okay.
Yeah, and if it closes above and it holds above tomorrow or so, you would see the momentum funds starting to buy as well.
Yeah, it's a bit like 24.50 with silver, right?
Yeah, it's a bit like that one. Jesus.
It's funny. But the price action for these types of levels is exactly the same, and that's important for traders to learn the patterns that you get sometimes in markets. You do get these big solid levels, whether on a 15-minute chart, a daily chart, an hour chart, and the reaction is always going to be the same. Either it holds, and the more times it holds, then the chances of a bigger break when it does go. Conversely, if it holds and stays holding, then you get a decent pullback. I've highlighted this level before we came up here, a level I've been watching for years and years because it's had prior action all the way through. And when you get a reaction, the reaction can be big off of it. It's okay to look at a daily and weekly chart and say, oh yeah, it touched there. But that could have been over the course of 2-3 days. So you may have to wait a few days before you suddenly get a reaction that gets you 400 or 500 pips. And the same could be sitting up here. If this holds for an extended period, maybe then we get a move all the way down to 105s, maybe even worse, because that's how these levels work. But as we're saying, if you get a break, potentially it has the legs. We could be talking 110, maybe up to the 112s if it goes over time, and this then becomes a decent support level. Patterns are the same.
Yeah, go on. I'm just going to add something afterwards. Carry on.
Go on, mate.
Now, I was just going to say this kind of setup for me is one of my favorite setups because you know where you're wrong and you know what to expect. So basically, what you want with every trade, right? You want to have the probabilities in your favor. They don't have to be massively in your favor, but they have to be in your favor. So what I will do, if this breaks above the highs, I will. Getting long, I'll put a stop below those highs. So what is a high? 108.70. I can't remember what is it.
Yeah, 70.75.
If it's, let's say it's 108.70, I'll get in on a break above. So I'll probably get in 80, 85, wherever I can get in. Put a stop below 108.70, probably 108.55 or 60 or something like that. Something relatively tight. What you will usually see is a thrust higher, then a comeback and retest that breakout, like Ryan said, and then if on the majority of the occasions, it will then continue higher. If it doesn't, then it goes in and reaches your stop, you're out. You know where you're wrong, the end. But on a majority, I would probably call it at least 60-40 percentage. It might come back and retest. It might not. It might just keep going. But if it does not take your stop, then you're going higher. Then your risk reward is a lot higher than 1-to-1. Clearly, it's going to be 1-to-3, 3-to-1, or 4-to-1. So if you have a slight percentage edge, and you do this enough times, you're going to be winning. It's like poker. You look at the numbers, you look at the probabilities, you keep playing the same hands in the same way, and you're going to eventually win. You can't win on all of them. And the secret is when you lose, you fold and you go to the next one. That's what most people don't do. Anyway, sorry about the theoretical thing, but I really like this setup.
Yes, it's good advice, and I'm exactly the same. I love these sort of setup because it sets you up potentially for a break. But if you've been shorting into this level, it's got you decent pips. But what you have to think about is how many times are we going to test it before we break it? So every time, if this was a big level I was shorting into, I may have a couple of goes, but get into this area, I'll be shorting with smaller risk. And maybe a bit tighter on the stop, just bringing it down a little bit because we keep coming back here, and I don't like a price that keeps coming back. So there's ways to play it for both sides. If you want to sell the euro dollar, here's your level, but just be wary of how many times we're up here, and as I say, maybe lower your risk each time you have a good trade off of it, just to protect that money that you made previously. You don't have 5 trades that make you decent money and give it all back on one where the stop gets blown. So there's always two sides to play.
One more thing, Gavin says retest of the breakout is key for me to see what happens there if it happens. Yes, but if it's a trade like this, you might break out and never come back and retest. And if it just keeps going, I would hate myself not being on the trade. I don't want to wait for the retest, because if this goes and it keeps going, it's a trade you've been following, your plan, you have everything, and then you're not in it, which is, for me, worse than losing money on a trade. Anyway. Because you want, these kinds of trades can be the big winners, and you want those. You can't miss them.
Yeah, anyway. And you've also got the opportunity. If we get a break here and it's worth 10, 15, 20 pips, bang, you can take some off the table. You've already reduced your risk.
Exactly.
you know, then if your stop's 20 pips under here and you bank 20 pips on half there, your trade is break even right from the first instant. You lose nothing except maybe commission. That's it. Your risk is down to zero, and that's the fundamental basis of every trading. Get your risk to zero as quickly as possible, then worry about the profit. But you're right, what you say still about breaking, and Gavin, yeah, I look for two things on a break trade. One, is it bubbling? Is it going to explode? This might be an exploder. Then as I've looked at Aussie dollar over the last couple of weeks, you know, these didn't look like exploders. You know, I said maybe once we get above this area here, you know, it needs to take out 69.20. I want to see it work on it. I wasn't expecting it to go through here and straight up to 70. And so I didn't go with buy stops. I waited for the confirmation. I bought the dips back that we got. And here we get the confirmation. Here we get the price action. It doesn't explode through. Yeah, it moves through quite a bit. Then it comes all the way back down again. It's not ready to break just yet. And then finally we get a bit of a break. And then you get a confirmation. Then it's moving up again. The same's going to happen up here. You know, I want to see this 70, 25, 30 area broken and holding as support. Because until then, it's still going to be a bit messy in between here. So I'm not happy just to go in with a buy stop, 20 pips through the 70 level and see what happens. I might do that in something like euro dollar because it just looks different. But that's something that that traders have to learn, looking at the patterns. You know, when you get highs that make a little bit of a high, then they come back down, then they nudge up, then they come back down. It's not clean. This is clean. This is as clean as you're going to get for a technical level number that is holding. So those are the differences you look at. Go for a clean break on this one. I wouldn't go for a clean break trade on the Aussie dollar. I'd look for the confirmation of coming back to the broken area and testing. Oh, there's a nice bit of education for the morning. Kate, we'll have a little look around the bits and bobs and dig into those yen crosses.
And I'll have a look. I'll show some charts tomorrow.
You got some charts as well. We are blessed. Look at that, folks. Who wants to go first? Shall I toss a coin?
No, whatever you guys want. Sorry?
There's a question from Charlie on what you were just talking about, the breaks, and I'll let you take it. What if you get that break of your level but momentum stalls? Now, you've talked about everything, so go ahead, reply to that. I know the answer.
If you get a break of your level and momentum stalls, that's fine. It's still a break. My levels are there. You know, it could momentum could stall and then pick up again. As from the moment I'm in the trade, I have the level, and the level is there. Obviously, if something material changes on on a more, I don't want to say macro level, but on a, you get some kind of data or some kind of comment or something that can throw the trade off of, I might close it before we get to a level. But as soon as I put the trade on, I have my level there, and then my stop is there. Obviously, if the trade goes fast, it's a lot better, but it could stall, then pick up steam again. I personally don't mind. I personally don't mind the way it gets there, as long as it gets there.
And it's as you said a minute ago, Stel, you've got to try and cover all your eventualities. So if let's say in this one, let's say we all stick buy stops in at 108.80. Okay, we break through, we get up to 109. Okay, you have a decision to make. Okay, it doesn't matter. This could go to 112. We don't know. It could go all the way back to 107. We don't know. All you can do is manage the trade. So if we get up to 109 and 109 starts to look like it's resisting, fine. I would take some money off the table.
Yeah. Because
all I want to do is reduce my risk first and foremost. So now maybe, let's say I'm long 108.80. I managed to get some away at 108.95. So I've banked 15 pips. My stop was 20 pips on below the level. Okay, so now I'm potentially only going to lose 5 pips on the whole trade. Well, that's much better than losing 20 pips at the start. So even if it does stop there and come all the way down and I get stopped, fine, I've only done 5 pips. We don't know what the market's going to do. What you want to stick with is your plan, and stick with giving yourself a greater opportunity to ride a break if it happens. And if it doesn't happen, you want to lose as least as possible. That's the only way to look at it. Look at it from your risk perspective. How much can I win? How much can I lose? More so, how much can I lose? And if you get your risk down and low, doesn't matter if it fakes out. Doesn't matter if it gets up to 108.99 and goes all the way to 105. If you've managed that properly, traded around it properly, you've lost 5 pips. So what? You didn't lose 20 pips. And that ratio is always good in my book.
And the other thing to always remember, you might put a trade on, might have the right idea, the move might happen, but first it might stop you out, right? So this break, maybe, go up, you get long, it goes up, hits your stop, and then it goes to 112. You have to learn to accept the loss. You have to learn to accept that you had the right idea, but the market took you out. If you don't do that, you will run your losers and you will get destroyed. That's the secret, not to make big losses. So you have to come to terms and be happy with the fact that you're going to be wrong quite often. And that's the problem that most people have. In the comments I see and people I speak to, it's like, oh, I knew it was the right trade. I kept it, and then it became too big, and the loss was too big, and I lost, my whole year's year-to-date P&L. You cannot allow yourself to do that. Yeah, I know exactly. It's a cliche, and a lot of people talk about that, but you have to leave your ego at the door and understand you're going to be losing often, and be happy when you're losing, because when you're losing, it means you're losing small. And you keep going and you keep going. And if you do it enough times and you have a statistical edge, or you have a method that you find is working, then in the end, you're going to be making money overall.
Yeah, I had a look at a couple of stats from our trading last year, and quite surprising. My average winning trade was something like 81 pips. My average losing trade was 26 pips.
That's awesome.
That's the ratio you want to keep. So I'm happy to lose 5, 10, 15, 20 pips trying to break in something like euro dollar, because you're not going to get them all. You may catch the one where it doesn't work and you get stopped out. I tried it last week. I bought into 108 here, had a stop at 107.85, got down to 107.80. So 5 pips and I was wrong by, and then it rallied all the way back up again. Shit happens, but you've got to make sure your losers are far less than your winners. And when you get on a winner, you want to ride it. You want to get your risk down and ride it as far as you can go. I'm still in a long oil trade that I did over the inventory data last week, purely because it's winning. I don't want to give it up. I've been knocking bits off as it's been rising. I haven't got much to cut before I have to close it all together. But when you get in a winner, you've got to ride them. And you manage that with your stops, having a trailer behind and seeing where it goes. Because if you get a runner, it's going to go. Then you're going to make plenty of pips. And that's how you increase your ratio between how much you lose and how much you win. They don't all go like that, but keep in a winning trade if you can. I hate giving up a winning trade unless I'm forced out by a stop or something like that. Yeah. Anyone else? While we're doing the lessons 101 for trading, okay, you ready to go, mate?
Oh, I was ready from the start, but I just wanted you guys to take this.
Go on, you go, and then Stel, you can grab it as well.
Oh. I can grab it tomorrow. Is that okay? We'll get the CPI today, so I can probably have more stuff to show tomorrow.
Yeah, all good, mate. All good.
Yeah. Okay. So Ryan already showed the euro dollar. Cable is doing exactly the same, and is even I'd say more beat than the euro dollar is beat right now because of this of the euro sterling gradually coming off. I'll have a look at the euro sterling as well, and also the reason why I'm not in the trade anymore, because that means
yeah, you got out too. I got out a couple of days ago.
I got out at 80 yesterday, 88.80.
Oh, cool. That's
I was up for the labor report.
Nice.
And it was trading around 85.90 or so, 88.85.90, and then labor report came out, and then with the euro a bit struggling around levels, and then I went like, yeah, all right, let's take the money and run and see what happens. And then then this ECB rumored piece that was absolutely, and I kind of hate myself for not having called crap on that one yesterday when we were back at 107.70 in the euro. But yeah, so I went out of my euro sterling yesterday early morning, So the cable here, we are entering an interesting zone. Okay, and for once, I'm going to go from short to longer term, and we shouldn't be doing this, but it's just easier to show what's going on in the shorter term. So we had a couple of tries to get. Well, first of all, we did a bit of a yo-yo in the cable for a while. Tops around this 122.5 with this spike and then coming back. But if we look at this, we were starting to find decent bids. I've also seen what's happening. This was part of my decision making in euro sterling as well. And then yesterday, I actually decided to. I started to look at actually long cable because numbers on the one side and the dollar not looking too fresh. We had those data on the dollar, and I saw the yields starting to come back down, and I went like, yeah, perhaps cable could have a little bit of a move higher. So I lent against actually overnight again against this 122.40-50 zone, the prior tops, and bought a small cable this morning. Took some off just before this trend line around 20. Took a little piece more off when it came up to this 123.50-60 zone. There's a bit of a prior top here as well, but the combination of what's happening on the data in sterling and what's happening with the dollar tells me that this thing could actually perhaps push through a little bit, and that's why I'm going to look at a bit other levels. So we've got this 123.50-60. We're riding it. If we get higher, there could be a push back up to the prior highs here. All of that, if you're a really short-term trader, I would look at 123.15-20 for a starter, and then the 122.5 again. But if you're well, the 123.15-20 is really for the short-term traders, and I think the other traders for a bit more longer term or with some deeper pockets or trade smaller amounts, you can look at the 122.40-50 again. That's the level that I'm looking at. But I reckon there may be a bit of a push through here. Also, if we get some help with the from the euro dollar, if it breaks through that 70 that Ryan showed earlier, I reckon that could be another trigger for cable to go higher as well. And in regards to that euro dollar, so this for the cable, and in regards to that euro dollar, Ryan showed it already. To me, the magic level is still here, 108.95, 109. The figure, I think it's 109.03 is the level for me. Where is this one here? It's the 50% of the 122.70 down to the lows. That's where the Fed started to pivot, and I always like to take this level because it was a really change of tactics from the Fed, and I think this is the important level to watch. Other people are watching this one, and that level would come in around 109.40. So I heard a lot of people talk about a 109.40 as well, but I think to me at least, this because fundamentally it's a more important shift that has been operated there. So to me, it's going to be around the 109, the figure, and I would not rule out more take profits around there. Although I just put in a stop entry to that through that 108.70 as well, 70.75 as well. I think if it goes, and it looks like the dollar is still on the defensive, euro dollar may all of a sudden push, and why not get a test of the 110 if we push through these levels. Euro sterling. So this one was the yesterday's push. I was also looking at this little level, and I've already mentioned a lot of times the 89.15-20 zone on the euro sterling, and we've failed. Then yesterday's data convinced me to take profits. I have not started to reload again, even though this 87, 60, 70 could look a bit juicy. But something, since I'm a bit long cable already, I'm don't feel in a hurry to buy euro sterling right now. I'm not ruling out a retest, and then we'll see what happens here. The big zone to me is still going to be here, this 86, 85, 87, the figure. But let's see how stuff develops. Because if the dollar really goes down more, since there is less liquidity in cable tends to go a bit faster than the euro. So a lower dollar tends to weigh a little bit on euro sterling as well. That just out of experience. Right then, when we wait, we don't get into the trade. that's what's happening on the mix right now. Dollar mix is entering quite a big zone here between 1865 and 1850, which is the low, the pre-pandemic low. This is when the pandemic started and the rally started. We're back there in dollar mix. I've been talking about this level for a while. It was my target, but looking at how the dollar is behaving, I'm not even sure that we can call that a target now. Again, and it is possible. Also with Banxico seemingly still being okay on their rate hikes, at least factoring in another rate hike, and them being already above 10%. This could actually go down to 1790. And I'm not bearish on the euro right now, but this one is a different story. We did get a rally back into the 2040s yesterday, and we are already trading well below. If this thing starts to go below 1995, we could see an acceleration again. So any rally, I think I'm going to try to counter trade this once more. What else? Is there anything else? Anything else? Oh, on the dollar mix, I saw somebody asking about the dollar mix. I think now you have to look at what happens if we start to confirm a bottom here. We could make a move back, starting around 1888. Back up into the low 19s, but I think for as long as the rest is not changing massively, we should be finding offers now in the low 19s towards 19 and a quarter. That's the idea I've got right now. I hope that helps on the dollar mix. What else? In the meantime, euro is coming back down, so another proof that 108.70 is now really getting to be a big level. Dollar yen is retracing just smalls. Anything else going on? Yeah, no, I think I'm done. Back to you, Ryan.
Thank you very much, mate. Right, Stelios is going to regale us with his charts tomorrow, so that's all fine and dandy. Right, well, I hope we've given you some good info to go along with, bit of insight into what the Bank of Japan's doing. Keep an eye if you're trading yen on that inflation data to come. It could be another kicker up, or it could feed into the mood and sentiment that we're seeing. Also, have a look at that euro dollar level. You know, we've given you I think enough guidance to learn how to trade it, to know how to trade it. If you want to have a go at it, put it to good use. That's what we're here for, to give you sound advice on how to trade, not what levels to buy and sell, but how to execute those trades should you wish. As always, thank you very much for supporting us here at the Flow Show. Thank you, Kay. Thank you, Stel. We shall see you all tomorrow.
Thanks, everybody. Thanks, Ryan. Kay.
Have a good day, guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.